For many years, the FICO score has been a dominating factor when it comes to borrowers applying for a new mortgage, credit cards, and even auto loans. But changes are coming, and big lenders are moving away from using the FICO scores, but instead relying on their own data and metrics to determine the risk of a potential borrower. Even Fannie Mae and Freddie Mac, the government-backed agencies, are starting to consider using other types of data and other scores when it comes to securitizing mortgages. So in this video, we're going to dive into how this will impact the housing market, how this will change your ability to borrow money in the future, and what could be the start of a social credit system. So FICO scores range from 300 to 850, 300 being really, really bad, and 850 being, pretty much perfect. And the highest credit score I've ever seen was 835, so I've never met a person with the perfect 850 FICO score. The way that FICO scores are primarily calculated are, first of all, your payment history, how well you pay your loans on time. Second being your credit utilization. This is how much of a revolving credit you use and how much credit you use in general. Number 3 is your credit file age, meaning how old is your credit. The longer you have your credit file and information in your credit report, the better, as it gives more predictability and data for banks to go ahead and assess your risk. Number 4 is your credit mix, so how diverse your different credit accounts are. Do you have auto loans, mortgage, student loans, credit cards? The more diversity in your credit file, the better. And last but not least, number 5 is new credit, essentially how many of your credit cards and accounts are essentially new. FICO scores have been a gold standard for many, many years for banks to assess whether a borrower has the ability to pay back their loans. But just like what I mentioned earlier, banks are moving away from using FICO scores in general. You see, FICO scores have been dominant for a very specific reason, and that is because Fannie Mae and Freddie Mac has been dictating that FICO scores have to be used when lenders are using a credit score to determine and underwrite a borrower when it comes to getting their mortgages. Well, for many banks and many lenders, they pretty much said, you know what, if it works for mortgages, it must work for credit cards and auto loans. Well, because mortgages being a really high ticket loan, they pretty much thought, well, it's got to be the riskiest, therefore it could work for other credit loans as well. According to a recent Wall Street Journal article, Fannie Mae and Freddie Mac are now considering using other type of scores such as Vantage Score, which is a rival score to the FICO score when it comes to underwriting for mortgages. You see, something I haven't mentioned is that there are different types of FICO scores. There's FICO 2, 3, and 5, FICO 7, FICO 8, and the new FICO 9. There's Vantage 3.0 score, National Equivalency score. There are thousands and thousands of different credit scores that are out there, but it just happens to be that FICO score has been the golden boy because Fannie Mae and Freddie Mac said so. Added with the fact that millions and millions of homeowners and borrowers have gone through mortgage forbearance programs and loan deferment program due to CARES Act last year, it has completely thrown off the accuracy and how data has been stored when it comes to credit. Because the CARES Act has allowed millions of homeowners and borrowers to get into forbearance programs without any negative consequences to their credit. So obviously the banks are saying, well, that doesn't really help our situation when it comes to assessing risk. So that has ultimately resulted in banks looking in other directions and other data, which we're now starting to see individuals with really low FICO scores even getting approved for mortgages and loans. Even big lenders like Synchrony Financial, which they're mostly responsible for store cards, are now moving away from FICO and it has completely switched to Vantage 3.0. So what exactly are banks looking at if they're not looking at credit scores? Well, banks are starting to look at deposit histories, how often you go into overdraft, and they're looking to see what other financial credit and products are using when it comes to determining the creditworthiness and risk of the borrowers. This could also lead into banks wanting to look at what kind of job you have. They may want to see how much money you got stored up in your checking account or your savings account, and how large your deposits are and how often those deposits are when it comes to pretty much determining the risk as a borrower. So I'm going to go and change up the gear a little bit and talk about how this will impact the housing market and the real estate market in general. So first of all, this could be a really great news for individuals with great income history, deposit history. They rarely get into overdrafts. They have really good jobs, but they may not have a good credit history. So that's a good news for them, as banks are increasingly looking at other data and they might not look at credit history as much. So these individuals may get approved to go and buy a home. Therefore, we may see an increase of demand and also more purchases down the road. But on the flip side, this change can exclude individuals with great credit, but they may suffer in terms of deposit histories, income, and other factors outside of credit. To me, I see this going in one or the other way. The first being is that we're going to see a lot of borrowers with bad credit getting approved for mortgages, which would drive up the demand and keep the pace going in terms of how hot the housing market is. The other way that I can potentially see this going is that it's going to have a complete lopsided changes when it comes to the underwriting system. So we may basically see a wash between the people who can qualify and people who used to qualify not being able to qualify anymore. So now we may see a complete 180-degree change. So when it comes to credit scores, they are important, but it is becoming less and less relevant when it comes to lenders looking at borrowers wanting to apply for mortgages, auto loans, car loans, credit loans, the whole 9 yards. So in the future, if you're looking to apply for a credit card, for an auto loan, for a mortgage, do know that banks are starting to shift and change, not from just credit scores, but also now looking at other factors as well. Now, earlier in this video, I uttered the words social credit, and this might bring chills down to your spine or may give you goosebumps. That's because in China, they are using some form of a social credit whereby your choices, your behavior, your social status, your job, who you hang out with, can determine whether you are qualified for certain financial products or you don't qualify. And that's not all. In some parts of China, social credit is being also used to deny entry to certain services. They may use social credit profile to allow you to vote or not allow you to vote. And it's got a big major factor in pretty much how you live your life. Now, here in the United States, thankfully, we do have laws and regulations that prevent things like social credit from happening. But there is a bank that is starting to use something like a social credit system to determine your future ability to borrow money. Now, there is a bank here in the United States that offer a very specific type of a loan that looks at what products you're looking to buy. Now, I know you're saying, well, that's pretty much everything, right? Mortgages, car loans. I mean, they want you to use a mortgage to buy a home. But consider this. There is a bank that offers what's known as a buy now and pay later loans. And you may have seen those in certain, shopping sites that are out there. Well, this bank is wanting to see what products you're buying to determine whether you qualify for that loan or not. So for example, a fitness equipment. If the bank knows that you're borrowing money to buy a fitness equipment, they see that as a positive step to increasing your health and your quality of life, and therefore the banks are more likely to approve that loan versus if you went out and said, I'm going to borrow money to buy the latest video game console. This bank just may deny your loan purely based on what you're buying, and they think that you might get addicted, and they may determine that buying a new video game console might be a bad direction to your life's quality. So while this may not be a full-blown social credit system, it is a step towards really the banks determining how we live and what choices we make, and the freedom that we get to choose whether we want to buy video game consoles or a fitness machine or fitness workout machine. So I don't know what you guys think about that. Go and leave your comments down below. Is that step towards what could be a social credit system, or is that smart? Is that something that the banks should start to use? I don't know. Tell me what you guys feel and think down below. In fact, what I'll do is as soon as this video is published, I'll spend the next hour replying, commenting, and having a conversation with you guys. So that's it, guys, for this video. There's a lot of changes coming to the credit scoring model and how borrowers are being assessed for risk. So if there are other changes coming down the road, definitely subscribe because I'll tell you guys exactly what those changes are. With that being said, thank you so much for watching, and I'll see you in the next video.